A $3.7 billion resort opened on the Las Vegas Strip and almost immediately began operating under visible financial pressure. Why is this happening? What is being hidden behind the glass facade of one of the most expensive properties ever built in the city? And who is really benefiting from a model that appears structurally misaligned with demand? But there is a deeper concern. This is not just about one resort struggling to stabilize. It may signal a broader shift in how Las Vegas itself functions. Because when a project of this scale cannot reach equilibrium, the problem is rarely isolated. Stay with us as we break down what is really happening beneath the surface. If you value this kind of analysis, consider subscribing and enabling notifications for deeper investigations. Fontainebleau Las Vegas officially opened on December 13, 2023, after nearly 2 decades of delays, tawakuf, and restructuring. But the origin of this project goes back much earlier, to 2005, when developer Jeffrey Soffer announced plans to bring the Fontainebleau brand from Miami Beach to the Las Vegas Strip. The initial vision was ambitious: a 67-story tower, over 3,600 rooms, and a total development cost estimated at approximately $2.9 billion at the time. The goal was clear: redefine Las Vegas luxury by shifting away from a gaming-heavy model toward a more diversified, high-end hospitality experience. Leadership projected that gaming would contribute less than 1/3 of total revenue. At that moment, the timing appeared favorable. Las Vegas was in a growth cycle. Property values were rising. Visitor volumes were increasing. The north end of the Strip was expected to expand, supported by projects like Wynn Las Vegas and the planned Echelon development. But the trajectory changed rapidly. In June 2009, after the impact of the Great Recession, the project filed for Chapter 11 bankruptcy while approximately 70% complete. Construction stopped. The building remained unfinished for over a decade. Ownership changed multiple times. In 2010, Carl Icahn acquired the property for roughly $150 million. In 2017, it was sold to Steve Witkoff for $600 million, with plans to complete it under a new identity. Those plans stalled again in March 2020 due to the COVID-19. When Soffer reacquired the project in February 2021 and secured approximately $2.2 billion in new financing, total project cost escalated to around $3.7 billion. What was once conceived during a boom cycle finally opened in a fundamentally different market environment, and that contrast now defines the entire story. To understand the pressure Fontainebleau is facing, you have to look beneath the surface, into how the asset is structured. The property is owned and operated under a vertically integrated model led by Jeffrey Soffer through Fontainebleau Development, in partnership with Koch Real Estate Investments. Unlike many Strip properties that rely on sale-leaseback transactions with REITs, Fontainebleau did not adopt a traditional triple-net lease structure tied to firms like VC or gaming and leisure properties. At first glance, that appears to reduce one layer of fixed rent obligations, but it introduces another form of pressure: debt. The project carries more than $1 billion in secured debt tied directly to the asset. This includes construction financing arranged around 2021, with refinancing expectations embedded into the capital structure. These obligations are not flexible. Interest payments continue regardless of occupancy or revenue performance. And timing matters. Much of this financing was secured in a low-rate environment, but refinancing will likely occur under higher interest conditions, increasing the long-term cost of capital. There is no external landlord collecting rent. But the financial system still demands payment. This is the key mechanism. Instead of rent escalation, Fontainebleau faces debt servicing escalation. Instead of lease pressure, it carries capital pressure. And because the asset is so large, even small deviations in revenue performance can significantly impact its ability to meet those obligations. This is where the structure begins to define the outcome, not the design, not the brand, but the financing underneath it. By late 2025, the gap between expectation and reality had become measurable. Fontainebleau Las Vegas has not publicly confirmed profitability as of Q4 2025. Internal performance indicators suggest the property is still operating below the level required to stabilize its capital structure. Occupancy remains the clearest signal. The resort has been operating in the mid-40% range. In comparison, most strip properties require sustained occupancy between 85 and 90% to maintain healthy margins. Average daily rate is estimated to be below the $300 to $400 range, typically required for a $3.7 billion asset to generate sufficient revenue per available room. Gaming performance has also lagged. Casino floors have shown lower utilization compared to nearby properties like Wynn Las Vegas and Resorts World Las Vegas, both of which operate with stronger demand consistency. At the market level, data from the Las Vegas Convention and Visitors Authority shows that in June 2025, visitor volume declined by 11% year over year. Strip occupancy dropped to 78.7%, while revenue per available room fell by 14%. By Q1 2026, strip gaming revenue had declined for 3 consecutive months. Fontainebleau is not just underperforming, it is underperforming in a market that is also weakening. This is where the pressure becomes structural. Fontainebleau is not dealing with a single weakness. It is managing a system of fixed obligations that do not adjust when demand softens. First, debt servicing. With more than $1 billion in secured financing, interest payments continue regardless of performance. As refinancing approaches in a higher rate environment, the cost of capital is likely to increase, tightening margins further. Second, operating leverage. A property of this scale carries significant fixed costs. Staffing, utilities, maintenance, and entertainment programming do not scale down easily. When occupancy remains in the mid-40% range, cost per occupied room rises sharply. Third, capital intensity. A $3.7 billion asset requires continuous reinvestment to maintain its positioning. CapEx is not optional. It is required to sustain a luxury standard. Fourth, depreciation. Large-scale resort assets experience high non-cash depreciation, which impacts reported earnings and investor perception. There is no rent escalation from a REIT, but the pressure exists in another form. Debt replaces rent. Interest replaces lease payments. And unlike flexible pricing strategies, these obligations are fixed. The result is already visible. Layoffs of approximately 60 dealers in May 2025. Underutilized casino space. Occupancy levels far below sustainability thresholds. This is not a future risk. The pressure is already present. Fontainebleau's challenges are not isolated. They are unfolding within a broader shift in the Las Vegas market. Data from the Las Vegas Convention and Visitors Authority shows that in June 2025, total visitor volume declined by approximately 11% year over year. Strip occupancy fell to 78.7%, down from 85.2%. Revenue per available room dropped by 14%. At the same time, traffic through Harry Reid International Airport has shown signs of slowing growth, reflecting weaker inbound demand. The distinction between strip and local markets is becoming more pronounced. Local casinos, with lower cost structures and repeat customer bases, are more resilient. The Strip, by contrast, depends heavily on discretionary travel and high-spending visitors. There is also increasing competition from online gambling platforms, which continue to capture a portion of gaming demand without requiring physical presence. Overlay macroeconomic pressure, higher interest rates, elevated travel costs, more selective consumer spending. The market is not collapsing, but it is shifting. And in a shifting market, high-cost, newly opened assets face the greatest exposure. Here is the core paradox. Fontainebleau is one of the newest, most advanced, and most expensive resorts on the Strip. It has modern design, premium amenities, industry recognition, including a Michelin key in 2025. On the surface, it represents success. But beneath that surface, the structure tells a different story. Low occupancy, underutilized gaming floors, high fixed obligations. A market that is no longer expanding at the same pace. This is the contradiction. The property looks like a top-tier asset, but it operates like a system under pressure. And that gap is dangerous, because it creates a false signal. From the outside, everything appears stable. From the inside, margins are tightening and flexibility is shrinking. Over time, that misalignment compounds, not through sudden collapse, but through sustained underperformance. And in Las Vegas, sustained underperformance is what ultimately reshapes outcomes. So when all of this is placed together, the timeline, the capital structure, the performance metrics, and the broader market signals, the question is no longer about whether Fontainebleau can operate. It is about whether this model can sustain itself over time. A $3.7 billion asset requires consistency, not occasional spikes, not temporary recovery, but stable, repeatable demand that aligns with its cost base, and that alignment has not yet been established. This does not mean failure is inevitable. The property can still recalibrate. Convention demand can scale. Brand positioning can strengthen. Market conditions can improve. But none of these are guaranteed, which means the real test has already begun. Not a short-term test. A long-term structural test. Can a resort built for expansion adapt to a slower, more selective market? And if it cannot fully align, what does that imply for other mega resorts built on the same assumptions? Because this is no longer just about Fontainebleau. It is about the future of the Las Vegas model itself. If you found this breakdown valuable, consider liking the video, subscribing to the channel, and turning on notifications for more in-depth investigations.